It's time now for today's strategy session. Options markets are pricing in the U.S. 10-year Treasury yield hitting 5%. Currently, the bond market is actually offering a greater return to investors compared to the dividend yield from the S&P 500. So is now possibly the time to shift your portfolio from stocks and buy into bonds? Let's talk about that and more. We want to bring in Luca Paolini. He's Pictet Asset Management's chief strategist. Luca, that's one of the questions maybe on investors' minds here this morning, whether or not the bond sell-off is nearing an end, and it could be an opportunity here to buy in for investors. What do you think?
Hi, Shannon. Well, let me say that when you look at valuation alone, there is a clear and strong case for bonds now. You have even real bond yields at levels that we haven't seen in a long time. Unless you expect something really terrible to happen on the inflation side or a significant acceleration in growth, the current level of bond yields is very attractive. On the other side, you look at the equity side, and I still believe the fundamentals are quite supportive. Earnings are okay, growth is okay. At the same time, you have a significant share of investor portfolios in equities right now. And so I think some kind of diversification or reallocation into bonds makes sense. I don't know if now is the right time, exactly now, but I do believe in the next few months there will be a great buying opportunity for bonds, and we're already increasing our duration exposure in our portfolios.
And so where are you kind of sitting on the duration portion of your allocation right now?
Well, when you look at bonds, we see more value in European bonds, to be honest, especially in the high yield space. There are good yields. The ECB is going to cut rates more aggressively than the Fed. Inflation is more under control. So we think that there is more value in Europe than the US when you look at the bond market. But also in the US, I have to say again, we look at TIPS, 10 years TIPS, or 30 years as well. I mean, it's close to 2.6. So I think there are levels where it starts to become actually quite attractive. But for us, the preference is on European bonds, and we also start to like emerging market bonds because we feel that the dollar is getting very close to maybe not only cyclical peak, but even a secular peak potentially. So we want to be exposed to emerging market debt as well.
Luca, let's talk about one of your theses here, because you lay out a maybe comfortable but also potentially dangerous scenario or situation for equities in the months ahead. Explain your thesis and maybe what investors should be doing or should not be doing at this point to be a little bit more proactive.
I think, if you're sitting on a lot of profits because you have been overweight equity in the past few years, I think it makes sense to reduce exposure there. We still believe that U.S. equities should outperform in the next few months, but I think the case for equities is more difficult. Everybody seems to be overweight. Positions are very, very, very extended. When you look at the earnings season, we have an earnings season ahead of us. Consensus seems to be quite on the bullish side. I don't see how margins, for example, can expand from current levels. So I think some kind of, maybe a reduction of equity exposure makes sense. No reason to panic, though, because, again, as long as the U.S. economy is growing at 2% and inflation doesn't accelerate significantly, the macro backdrop remains quite positive for equity markets.
So if you think that we're going to see an adjustment of some of the margin expectations, how does that play into what has largely been expected by many strategists for a calendar year earnings growth of 15%?
I think it's far too high because, when you look at the last year, the big surprise was U.S. growth growing at almost 3% when expectation was 1%. So you have a delta of 2 percentage points, which is massive in terms of earnings growth and also margins. This year, we start from a already high level of growth. I don't see how U.S. growth can accelerate from the current level. And you see that real wage growth is positive. So effectively, wages are rising more than inflation, which was not the case, for example, 1 or 2 years ago. So it's difficult for me to believe that you're going to see a significant improvement in margin. So there is the kind of potential risk for disappointment, especially for the U.S., but not only. So I think there is a risk in the earnings season for investors to be slightly disappointed.
Luca, thanks so much for taking the time here with us just after the opening bell. Appreciate it.